Hi, everyone. Thank you so much for joining the first webinar of the year. Thank you so much for your time, and Elena and Alan for doing this awesome presentation all the way from Hawaii. Some of you are familiar with Alan and Elena. For those who are not, they have more than 21 years of combined real estate experience managing, selling real estate, and they own more than 5,600 units as a GP and LPM more than 20 properties. So I'm very excited for them to present red flags for passive investors. Well, the top 3 red flags to pay attention to so that investors can have the most direct route to financial freedom. Without much further ado, I'll turn it over to them.
Thank you so much, Christina. We are super excited to be here today. I am trying to see if we can switch to the speaker view. Okay. First of all, big thanks to Cashflow Portal, who is hosting today. It was a great honor, and we're actually super excited to be able to present on your guys' platform. We've had a great experience using Cashflow Portal. We're actually investors in Cashflow Portal as well. And we think it's a great platform, kind of bringing 2 worlds together, bringing the syndicators and investors, and giving opportunity to investors have access to numerous deals and education resources, and giving extremely convenient platform for syndicators. And Cashflow Portal has been really great trying to incorporate all the suggestions syndicators have and the feedback from the investors. So we are extremely excited to be part of Cashflow Portal and to be presenting here tonight. Today, we're going to go over the red flags for the passive investors. We're hoping to share our experience. As Christina mentioned, we are limited partners of passive investors in quite a few projects. And we started going into syndication first as limited partners, trying to get an experience and see what we like, what we don't like working with general partners. So we're hoping to share it with you more like a criteria, how to analyze the deal, how to look at the deal from the passive investor perspective, and what things to look out for. So first, we would like to share a little bit about ourselves, what our experience been, and where we're coming from. Alan?
Yeah, so both of us kind of come from humble beginnings. I always wanted to be a pilot, so I kind of dedicated my life to it. I moved to Alaska at a pretty young age and started flying little airplanes up there. And then I finally landed my dream job at Alaska Airlines, and about the same time met Elena, and she just graduated with her MBA in international finance and was working at Weyerhaeuser. And about that time, Weyerhaeuser started having corporate downsizing, and a lot of people in their 50s that dedicated their lives to Weyerhaeuser suddenly found themselves forced into retirement. And conversely, on the airline side, large airlines like United and Eastern and such were having large downturns. So we started thinking there's got to be a better way. And we already just started investing in real estate, just rental properties here and there. So then we started to develop the properties, and then that kind of snowballed. We started a development company and a property management company. Elena left Weyerhaeuser and started her own real estate brokerage company. And it all kind of grew and grew. And now, like Christina said, we just sold one that we're limited partners in. So we're down to 13 properties as limited partner, and we have 8 as general partners. And it's somewhere, since we sold one, it's somewhere in the neighborhood of 5,200 units. And we love passive investing more than being a general partner, to be honest. Do you have anything to add?
Yes. The only thing I would add is that being a passive investor, you will come across many deals, and you will be evaluating lots of deals. Oops, I went too far. And is that this blank slide or?
Yeah, that's fine.
Okay. So one of the important things which we learned through our real estate development and real estate acquisition process, it's super important to kind of identify and know your own criteria as investor, because you will be presented lots of deals from different states, different type of properties. And it's super important to know your criteria first, so you can identify if that's their projects which meets your criteria and what you will be interested to invest in. And first of all, we also would like to say that we are not their financial advisor, CPA, or legal attorneys. So all the information we're sharing today will be just based on our experiences, and you're very encouraged to discuss it and talk with your CPA and attorney as well.
And so before we get too far into this, so we're all on the same page, I'm not sure how new people here are. Some of the people in here are passive investors with us. Some of them are even general partners with us, like Clayton. That's great that he showed up. Thank you. So a GP is a general partner, typically 3 or so people that know each other, hopefully for a few years. They all fill in each other's weaknesses. They get together and they start looking for properties, and they'll send in a few letters of intent or LOIs. They'll finally have one stick, so to speak. And then they'll go to a lender and they'll double check all of some of their underwriting, and they'll create a general partner LLC that kind of binds all the general partners together. And the bank looks at us as a group and the asset, but not to limited partners. And we have the property inspected. So by the time the limited partners see the deal, we're probably 2 to 3 weeks into this and a lot of capital. And then we start a LLC for the apartment itself. And then we seek out limited partners that invest in that LLC. And the limited partners, they could be they could just be a married couple, single people. Some people like to invest in their self-directed IRAs or their solo 401ks. Sometimes 1031 exchanges are allowed, but it's kind of difficult to get the timing right. And you need to talk to your GP if that's your plan, basically. And some things to keep in mind on most deals that we see, the general partner LLC owns 20% of the Park Place LLC, and the passive investors as a group own 80% of that LLC, the apartment specific LLC. The general partners are B class and the limited investors are A class. This is kind of important. The general partners are the managers and the limited partners are the members. And this gets to be somewhat important. In a lot of these, the members have voting rights and they can actually vote the managers out. It's in the contracts, and I'll show you examples of it here in a bit. And so the criteria for an apartment, I think
Yes.
Elena's going to talk about this.
Kind of started going on that before we talked about the diagram. What helped us a lot is really narrow down the criteria for what kind of property we're looking for. You can change the property, you can update the units, you can make it all beautiful, but you cannot change the neighborhood, you cannot change the regulations of the city or the state it's located in. So you cannot change the flood zone. So as a matter of fact, one of our criteria is that if we're looking at the property in Houston, we will not invest in the one which is located in the flood zone. So also, depending on their apartment type, if it's a class A, B, or C, with class A, you will have a less cash flow, but you will have a newer property. With Class C, you will have higher cash flow, but it's more management intensive. So for Class B, which is kind of a blend, you can have not so old apartment and nicer neighborhood. So that became our criteria looking for properties as well. And also the location is, there is a lot of economic growth coming to the specific town or the state or the location. So you can really look and see if the area you're presented, if it's landlord friendly, if there is economic growth projected there, and you can really narrow down your criteria and decide what properties fit that. If it's a Class A apartment and there will be less cash flow, so you know that the cash flow will be either deferred or will come in place later. So if that's your goal as an investor, really look for properties which will help your capital grow, but there will be less cash flow. That might fit your criteria. But if you're looking really in the consistent cash flow, Class A apartments might not be always the perfect fit for you. We also like to see that the property management of the apartments, who is doing that. We're not big fans when one of the general partners actually has their own property management company and it's vertically integrated. We want to see experienced property management company who is present in this market, who has lots of numbers, 1,000 or more in thousands units of measurements under the management in this area, because they will have really good knowledge of their rental market, of the tenant pool. They will give you a good idea of what the rents could be. And also there is a lot to be said about economy of scale and how the local property management can utilize their resources the best. And also, depending on the general partners group, how many GPs is on the project compared to their project size, what are their roles, and how they complement each other. Anything else you think?
No, I think that
Okay.
pretty much sums it up pretty good.
So since we started kind of going into the GP team some more, the criteria to look out for and the red flags to look out for on the GP team would be to see if they're experienced and have solid track record. The best case scenario will be if it's the GP team who already done the projects before together, which means that they work together, they work great as a team, they had a successful experience working together. And we do look for the successful proven track record. That doesn't mean that the newer GP, we don't look at their deals or not interested. We are interested in new general partners, but we like to see that they're partnered up with experienced general partners who can share their experience and share their expertise on certain projects. And also, we think it's super important to see what the general partners' long-term goals are, if they align with your values, with your principles and your long-term goals. Are they looking for more of the legacy wealth strategy? They're looking to hold the property longer, maybe refinance, give some capital to limited partners so they can reinvest it again and hold the property longer? Or are they looking at short-term projects where they can go in, remodel the units and sell the property? There is nothing wrong with that structure as well, but that has to fit your goals, your criteria, because you will be seeing the property sold in 2-3 years. So you will need to have your tax strategies align, and those GPs most likely will be looking for another property to buy and reinvest, which also the other factor to consider is what fees are they looking for. Very often GPs who are looking for quick turnaround on the property might have more fees, acquisition fee, disposition fee, refinancing fee, and it might make sense for the project. We sometimes see a little bit higher fees if it's a new construction or build to rent, so GPs have to bring even more expertise and spend more time on the construction of the new property and getting it all ready to rent and rent it out. So, but it basically has to make sense and align with overall business plan. Also, what general partners are offering to limited partners in terms of the split. Alan mentioned that in most deals we see it's 80-20. We've seen the deals when it's 70-30, as I mentioned, for the new construction, but we also came across some deals where the split is 50-50. So in that case, as passive investor, you really need to evaluate and see what your returns and what GPs are bringing to the table, or what is that split is based on. And so all of that together kind of brings your first step in evaluating the deal, kind of to see who is the team behind it, what are they charging in fees, what are the terms for the limited partners investment, and also how well you know the GP, and if they're very transparent about the information they're providing, and if they're answering your questions. What?
Sounds great.
Okay.
Yeah, so hopefully, Lee, you can find a GP team that matches your criteria and the property too. And then I'm not going to spend a lot of time on this, the paperwork that goes with these. The reason I'm bringing most of this up is I just saw a really weird one, and I can't share the documents, but I can tell you about it after this. So the first, you have a company agreement, a private placement memorandum, and a subscription agreement. And the company agreement is typically about 50 pages long. It just states that the passive investors will have, it's a typical company agreement. They'll have 80%, or we're in one that the LPs have 83%. I never figured out why that is such an odd number, but so it'll clearly state 70-30 split. It'll talk about the authority of the managers. The things that I look for is I really want to see as a limited partner, we have the ability to removal of the managers with cause. It's in almost every document I see. I think it'd be very hard to do. I've never been involved in any deal where I've even thought about it. So it's just nice to know that you might have some recourse if it starts really going bad. And again, we've never been in a bad deal yet, knock on wood. And then the liability of the member. Now the members are the passive investors. So I want to see no member shall be obligated for any debt or liability of the company, things along that, and the voting rights. And if we scroll through, here's an example of what the paragraph will look like for the members can vote out the managers. Generally, we see Patel Law Group, Mauricio Raoul, or Gene Tobridge are the three law firms. I see most documents from them. There are others that are really good too, but I'm more familiar with their legal documents. And then in case you get divorced, there's verbiage in there. If you go bankrupt, there's all kinds of verbiage, and all of these talk about coming up with a fair market value when you try to sell your shares in such an event. And so it talks about how to get a fair market value. We're not going to read these all, but basically somebody has to hire the appraiser. It's just nice to see all this stuff. In the company agreement, it'll talk about what the acquisition fee, the asset management fee. It's just nice to see. Then the next document is a private placement memorandum. My favorite ones are the ones where they put the entire webinar deck in the private placement memorandum. It just makes it really easy. And then there'll be all of the description of the property, obviously, investment overview, but the risk factors. When you start reading the risk factors, they're pretty they're kind of fun to read actually, but the PPM is about 70 pages long. And in it, it also talks about you need a relationship if it's a 506B, as in boy. If it's a 506C, then it's all accredited investors. The general partners can advertise on Facebook or TV, radio, whatever. Most of what we invest in are 506B, so we need a relationship with the investors. So if you're on Cash Flow Portal, I love that meetup place that you guys have, the marketplace. But as a passive investor, you need to find people in there that are general partners or aligned with your goals, and just start a conversation with them, start a relationship with them. I think it's very important. And also in the PPM, oftentimes it talks about you have to have knowledge of financial and business matters, and you're capable of evaluating the merits and risks. That's kind of important. It also talks about it's limited to 35 accredited investors. A good PPM kind of quotes the SEC rules and it goes back to 1933. So
sophisticated,
yeah,
unlimited accredited, 35 sophisticated.
Yeah, sorry. Thank you, Clayton. And then lastly, the subscription agreement. This is the most simplest one. It's just about 10 pages long, and it just wants your name, address, phone number. There's some important things in there. Mainly to protect the general partners, like you can't be laundering money through one of these syndications. You can't be a shell bank or shell company for a foreign entity. Things like that we really get cautious over. So you need to disclose all of that. And then for red flags with legal documents.
Hang on, I love that. Oh, sorry.
So almost everything we've ever been pitched, except for like 2 deals, have had really great legal documents. They go just in line with what we just showed you. I just saw one the other day. It was about 4 or 5 pages long. And as a limited partner, you're not getting anything. You're not investing in the company. You're really not even getting shares of anything. You're just handing over your hard-earned money to the passive investor or to the general partner and hoping for the best. And so if you stick with more experienced GPs, I don't think you're ever going to have that problem. That's another reason that we think the general partners are more important than a lot of underwriting and such.
I just want to quickly jump in. There is a lot of paperwork and the documents. I know Alan is probably one of a few people I know who reads all of it. And I think it's super important for passive investors, for limited partners. When you're reviewing the deal, you do actually read through the documents and ask questions. No matter how simple or trivial they might think to you, it's important that you talk to the general partner with whom you have a relationship and ask all the questions. If you get overwhelmed with the paperwork, make a list of questions on the topics we just discussed. What are the fees? What are the splits? What happens if I get divorced? What happens if something happens to me? How do my shares go to my heirs? So you kind of need to have an understanding what's in the paperwork and what information is presented to you. And the next, we're going to talk about the numbers, and Alan is the one who analyzes those a lot too. So he's going to talk about it.
It's going to be real simple. I used to use spreadsheets and stuff to double check. Like as a limited partner, I'd enter stuff in my own spreadsheets. I quit doing that. You could just do this. You might need a calculator for one calculation, but most of it, it's just kind of common sense. So hopefully you get something that looks like this. It's kind of detailed, and we're not really going to go over it, but this is like what a quality general partner team will do. The lead syndicators will have something like this. And they get the data from like a T12. And hopefully they ask the property manager in the area that they already have a relationship with, like Clayton used Q10 because they manage something else that Clayton owns. It's just really nice. You can call them up and double check all your numbers, all your underwriting, what the expenses will be, how much rent you can expect to get. But so this is just one page of a T12. We're not going over all of it. You can tell it's really detailed. But the one thing that I really look for the most is something called economic vacancy. It's an easy calculation if they don't provide it for you. Somewhere in their pro forma and their underwriting that they're providing for you, it should have the gross potential rent or the gross collected rent or the gross possible rent. And you can compare that against the net income. And you just subtract the two, you get a dollar amount, then you divide that by the gross potential rent, and you have a term called economic vacancy. And that's really important if the business plan is to remodel half of the units. It's impossible to rent out to remodel without having at least a 15% economic vacancy. I like to see a little bit higher than 15%. But another way to look at it is you have the gross potential rent. If 100% of the units are occupied and 100% of the people are paying rent, you would be collecting your gross potential rent. But if you have you give the property manager a free unit and you give the maintenance guy half off, and then you start giving senior discounts to like 12 people on fixed incomes that have been there a while because it's a nice thing to do. All of that comes off of the gross potential rent. And then you throw in 10 or 15 units down for remodel. It really starts to add up pretty quick. A typical well-run apartment in Dallas is around 8 to 10% economic vacancy. And that's over the last 20 years. If you average it out, it'd be about 8 to 10%. And in Houston, for whatever reason, it's right around 10%. And so you need to keep that number in mind. And back to here, if you know what to look for, they lay it all right out there for you. This one's great because they actually did the math for you. They're predicting 17% economic vacancy the first year when the most remodels are going on, and then while they're finishing up remodeling the units, it goes down to 12 and then 10% and for the next 5 years. And I just love seeing that. I think that's a good thing to see. And another thing, when you go through these numbers, just make sure that it makes sense. Again, if you go back over 10 to 20 years, the average rent increase is 2 to 3% year over year. That's like a 10 or 20-year average. The last couple of years, it has been averaging 8 to 10%, maybe a little bit more in some areas. But you can't predict that for the next 5 years. It's very unrealistic. And same thing with the expenses. The expenses on average go up 2% per year over the last 10 to 20 years. However, with inflation, we've had some huge expense increases. So it seems to be averaging around 8%, I'd say, across all of our deals. Maybe some might be as low as 5, some as high as 10. And a red flag I'm going to bring up, because I'm seeing this often right now, is on the expense side. If you go out and you buy an apartment building and you're going to pay more than the previous owner paid for it, I can guarantee you your property taxes are going to go up. Or I'll give you a 98% guarantee the taxes are going up. They're not coming down. And same thing with the insurance. Over the last year, we've seen insurance rates increase as much as 20%, 30% on one deal. And that's properties not even in a flood zone. If your property's in a flood zone, I have no idea what's happening to you, nor do I want to find out. Or I'm curious to find out. I just don't want to be involved in it. So that's my biggest underwriting red flag is that. And anything else?
I like to look at underwriting, and sometimes the term gets confusing as the financial projections. So you want to see what assumptions and what projections general partners are making to be able to implement the business plan which they're proposing to deliver the returns which they're expecting on the property. So we really like to see the conservative assumptions rather than some very, very optimistic ones. Our goal's always been under promise and over deliver. So you really want to see somebody more on the conservative side with the assumptions on the rent increases or their economic vacancy especially. But if there are some optimistic projections, it's always good to check with the general partners and see what those assumptions are based on. Maybe there is a property which had really, really low rates way below the market value, and the local property management company does support it. So that can define their bump in the rent numbers for the first year or two. So to kind of summarize, in a perfect deal, in a perfect world, we're looking for a great general partners team who are experienced or who have experienced partners on their team. They don't have obscene fees. Lower probably won't be the right word, but they have justifiable and fair fees. 80-20 split, could be 70-30 if it's a new construction. And one of the things I don't think I mentioned that when I was talking about general partners. We like the general partners who communicate about the changes, about things happening on the property. We'd rather over communicate with the investors rather than go silent and not communicate details. So we love to see that in general partners, because things do happen when you have 5,000 doors, when you have 400 units of apartments, the trees fall down, their freeze happens, their plumbing issues come up. It's not the problems, it's how the general partners deal with that. We like to see the property which aligns with our criteria, which is in the areas with economic growth. The legal documents, if you have experienced general partners team, I think it's probably given, but we still put it there to make sure that you do review legal documents and they are detailed, they're prepared by legal firm, and all of your questions are answered about that. And the underwriting or financial projection has to make sense and has to be aligned with their plan and not be overly optimistic on all the projections. I guess we have 4 red flags on it. We don't have 3.
Over delivering.
So do we have to see everything perfect in every deal? No. And the point we really would like to make that we see extremes on both spectrums. We see some limited partners or passive investors who overanalyze everything to death or try to learn more, try to study more, and evaluate a lot of deals, but never invest. And we have some limited partners who never review the deal or look at their paperwork, just bring their money and say, where do I give the check? So has to be a great balance. You have to evaluate, look at the deals. Cash flow portal, I think, is a great resource for that because you have access to many general partners, you have educational resources, but I think for all of our investments in real estate, we wish we started earlier and didn't wait until we knew more or we started research.
Yeah, I spent 2 years
So-
studying stuff before we got into our first apartment syndication, and I wish I wasn't always looking for the perfect one. We're learning a quality GP team at all. They all seem to work out.
Yeah, so We always happy to answer any questions if you would be interested to join our investor community. We do hold in-person meetups in Bellevue, Washington, and we have regular webinars we do for passive investors on different topics. And we're also happy to connect with passive investors and start building relationships so they can learn more about us, about our projects. And we also have our giveaway. We have our ebook we put together for passive investors. So you can email us with subject ebook, or you can email us with their join in the subject to be added to our community.
Real quick,
So,
I'm gonna interrupt you.
yeah.
If you have any questions, you can either unmute or type them in your,
Type it in
or
your
type
chat.
it in the chat box,
Yes.
or raise your hand. But anyway, sorry to interrupt you.
No, you're good.
I was supposed to
found that-
mention that way early on and forgot.
Oh, that's okay. Yeah, you're already in our community, Clayton. So happy to answer any questions. You can put it in the chat. You can raise your hand or
Yeah.
unmute.
If you're not in our community and you want to sign up, just email us. It's easy.
Yes,
That's the easiest way. We have a website. It's the same as email. It's andoverholdings.com.
and there is a way to join there as well.
Yeah.
Okay.
I had a
Yeah.
question. You mentioned that for property management team, if the GP has their own property management team and is vertically integrated, you try to stay away from that. My thinking is, wouldn't you want to prefer a GP who has their own management team, because
It depends on,
I think it's a matter of personal preference. If you
Yeah.
don't mind me just providing my opinion, because
Yeah.
the challenge is this: property management is really difficult, and these property management companies deal with tough situations all the time, and sometimes they're not successful. So what if you partner with a GP that has a vertically integrated property management company that is managing the property and they're doing a horrible job? How do you fire that property management company? What
Okay.
strain does that put on the relationship of the partnership that operates the deal? It's just kind of a slippery slope. I'm not
I
saying
would-
you can't do it, but
yeah, we were doing a property tour on something that we own in Dallas, and lead property manager was in her office talking to the local judge saying, you got to stop giving people these workouts because none of them are, trying to pay rent for those 60 days or getting 60 days of free rent on top of the 30 days you already gave them. So it's nice when you're with a large property management company that can pick up the phone and call a judge. I love being in something that big. Also, like one that we team up with a lot in Houston is Q10 Property Management. They have tens of thousands of units, I think, in Houston, and they know everything going on in every neighborhood. They know exactly what, if you need granite countertops on this block, or if, one block over, you could just more or less paint the Formica countertop with garage floor paint and call it good. They know. And it's nice because you don't have to waste time studying it, trying to figure out which way to go and try a few units one way and a few units the other way. So we like that. I know there's some really good syndicators that are trying to start their own property management companies. I don't know. I'm with Clayton. I'd prefer to stay away from it. We always have, but that's just us.
I think
Yeah.
that makes a lot of sense. Yep.
And
Okay,
then
Kyle, you've got a question?
yeah, Kyle.
Hey guys, how you doing tonight?
Good to
Good.
see you.
Good. I met you guys through Julie's podcast.
Yeah.
So
Uh,
good to see
we
you guys.
we love Julie.
So my question could go on the LP side or the GP side, and it pertains to underwriting. So as I'm underwriting deals, I'm trying to be as conservative as possible. But what I've learned is you can tweak 1% of one stipulation and it'll have a cascade effect. So you might be
Yeah.
working a deal, and you're very conservative and it kind of doesn't work well. And you're like, well, what if my vacancy went down 1% and then boom, all the numbers work? Or what if I raise my rent another 0.5% trending and all of a sudden the IRR explodes? How, either from an LP or GP side or both, how do you handle that underwriting phenomenon where, you know, there can be some exponential changes just by a small tweak that you really can't justify or unjustify because it's kind of up in the air?
Yeah, it depends on what spreadsheet you're using and how it works out. I know exactly what you're talking about. I've had deals where I've looked at it, it's like, oh, this thing's awesome. And then I go back and I find that I missed a number by a couple percent. And it completely changes a good deal into a bad deal. And I just keep looking at deals and keep underwriting, and then you'll just kind of learn and find people that have underwritten a lot of deals and that buy a lot of deals.
And I
Well,
also,
even,
yeah, if it's tweaking like 0.5%, there is always that margin which can go either way. So, but when it's
Yeah.
tweaking by larger number, or when you discover that the unit count is not used correct. So when there is like a negligent thing, when you look in their assumptions, it has aligned with the property management assumptions and like some other sources, not like you went and decided the rent's going up 10%. But I think there is always that little margin,
Yeah,
which is fine.
I've never had one where like tweaking the rent 0.5% or 1% makes a large difference. So I guess I'd have to see that particular deal.
yeah, I might be exaggerating. It was not so much
Yeah.
how the spreadsheet works, it's more or less changing our assumptions.
Yeah,
Yes.
so
Because you
your
said before, like your
assumptions-
vacancy
yeah.
is averaging 2 to 3%. Well, if you use 3%, it might not be enough. If you use 2%, maybe all of a sudden it pushes you over the edge. And I
yeah,
think it's easy
comment,
to fall into a
Alan?
trap of tweaking something
Yeah.
to make it look good.
yeah, Clayton has something to say, but before you do, Clayton, you gotta find some to forecast your rents out. They need to be based on something sound. I'd start with either Yardi or CoStar, and then I'd find a local property management company that owns the apartment across the street and see what they're doing. Yeah, go ahead, Clayton.
So I would just say that if you're on the general partnership side, you're putting the deal together, you're probably the one underwriting and you're probably the one making those assumptions. And if you're a passive investor, you're probably looking at a set of underwriting assumptions and trying to figure out if they're valid or not. In any case, right, whatever assumption you make, you need to approach it from the standpoint of it's going to get questioned, right? If you're a deal sponsor, your investors are going to ask you, where did you come up with these assumptions? Like, what are they based on? If you're going to go get debt for a potential acquisition, the lender is going to want to know where you got those assumptions. And especially if they, are not aligned with what their underwriting is. And so I would just say, like in your case, to answer your question, you should always have, where possible, some sort of data set that you can reference, like Alan said. So there's a lot of data aggregators out there like Yardi and CoStar and, apartment data. There's a lot of resources where you can go get industry forecast data for a submarket that your asset's in, and then you can tweak that based on market research that you do in the submarket. So you could talk to, competing properties. You could talk to property management companies that are very familiar with that asset class in that submarket and get guidance, and how that, and compare and contrast with these data aggregator, forecasts. So just keep in mind that, you're probably not ever going to see a deal being pitched to you that looks bad on paper, like horrible. Somebody's going to tweak their assumptions just enough to make it look favorable. And so you should always have like an inquisitive mind, like, where did these assumptions come? Where did the economic vacancy assumption come from? Where did your organic rent growth assumption come from, et cetera? And as long as you can answer those questions and point to some sort of substantiated source besides just, I picked it because it makes my deal look good. I work with this property management company. They have 5 other deals in the submarket in the same asset class. And over the last year, this is the actual data and this is their forecast for next year. And that aligns with CoStar forecast that I pulled the report on. And that's where I got the number. That should be more than sufficient to satisfy investor concerns or whatever. But there's definitely like a science part and an art part to underwriting, and the art part is that whole assumption bit. And nobody's perfect. Everybody kind of learns as they go. So the more sources of data you can get, the better.
Thank you, Clayton. And
Thank you.
we have one more question from Miriam. How are you finding properties for investment? I think it goes back, oops, I pushed it. We can stop sharing, I think, too. I think it also goes back to the question with identifying the criteria. We identified what markets are we looking for and what general partners we really would love to partner up with. So we'll look for properties in those certain markets in this particular general partners at this point.
Yeah, I get really like to go back when we were starting out, we knew we wanted in Seattle area, we wanted Alki Beach, we wanted within 1 or 2 blocks of the water. So instead of looking all over Seattle for properties to buy, we just focused on a neighborhood. With the apartments, we're doing the same thing. We want this city or we want that city. And so we're just, for our deals to GP on, we're just looking in 2 cities, and we want to be closer to the better schools, A schools or something. And as Clayton said earlier, the income really matters. You find the higher income neighborhood in the small town.
With the good schools and
And you
lots
can-
of economic growth.
Yeah, you can find all that on the internet. A website called City Data is great. You can just take a zip code or an address and type it in, and you can get down to about a 5-block radius and see what the income is for that radius.
So, yeah, so now we kind of laser focused.
So we just laser focus. I'm not interested in all of Dallas or all of Houston. I have specific cities. And then I rely on people like Clayton to find them.
Any other questions? I had one question texted to me actually about investing through IRA or solo 401k. And we had investors, I think solo 401k is the best, but you have to be a business owner. And with IRA, it has to be self-directed IRA. And you kind of need to plan some time ahead to make sure to transfer your IRA funds in the self-directed IRA. And we have companies we work with, so we can provide information and recommendations on that as well. So that is that question. So.
Any other questions?
Well, I have one last question.
Yeah.
Alan, you mentioned that you were studying real estate, or you were kind of more on a passive side for 2 years. What made you finally pull the trigger?
I just, I got into one of those, there's tons of group. There's, I think it's Kenny and Tamil. Am I saying that right? And then there's Fairless, there's Sumrock, there's many of them. And I think you should go to see a couple of them before you join one and pick the one that best aligns with how you feel. We did Brad Sumrock and we met great people there. The people that joined Sumrock are just, they're great people. So, and there was a lot of help and advice through all of that.
Yes, and first we started looking for a deal on our own.
Yeah, we tried to buy our own apartment and
it was
sort
super
of gave
hard,
up.
especially coming from Seattle. It was hard to find something in Texas on our own. Then we joined the summer group, started learning more about multifamily and investing passively. And then we started investing passively with different general partners and kind of saw the deals go through and how was the experience, how was communication, how asset was performing. And then after a couple of years, we asked the general partners who we liked to be able to partner up together on the property.
Thank you.
So,
Yeah.
thank you. Yeah,
This was great. Thanks so much for having us on, Christina.
Thank you.
Yeah.
Thank you so much for spending some time with us and giving us your top 4 tips for
Yeah.
investing in real estate. You outdone yourself. Thank you, everyone. If you can just show everyone again how to contact you. I think there was 1 or 2 people who joined in the last few minutes.
yes, absolutely. Let me go back on this one. So here is the best way to reach us. Our email and the phone numbers. And of course, you can schedule a Zoom call via Calendly and contact us after this presentation if you will come up with any questions. And also if you will come across any deals you have questions about or what to look for. We're always happy and open
Yeah. You
to
pick
answer
up the
any
phone,
questions.
you can reach us. We're
Yes.
not hiding.
Alan doesn't like
I don't
Calendly.
like
He
Calendly.
just call me.
Just
Yes,
call me.
yes.
Thank you. Thank you so much for presenting. I'll send everyone a recording and then thank you again. This has been very helpful.
Thank you, Christina.
Sounds great. Thanks so
everyone.
much.
Thank
Have
Thank
a
you.
good night, everyone.
Have a good night.
Stop. Thanks.